today to talk about the housing market. Westpac has revised its forecast for Australian house prices. The last few months has seen convincing signs of stabilisation in the market. Previously we expected prices to decline 16% from their peak in April last year to the end of this year. It now looks like a stabilisation has been established and prices will see a peak to trough decline of just 10%. The last 3 months we've seen some pretty clear evidence of stabilisation. Prices were about flat in February and looked to have posted decent gains in March and April. Every major capital city market has now seen prices stabilise. That's alongside signs from auction clearance rates and auction markets more generally showing an improved tone, and other indicators such as turnover also showing signs of steadying, albeit at very weak levels. What's driving this shift? Three factors stand out. The first is a much bigger than expected resurgence in net migration inflows. Westpac expects net migration to top 400,000 for 2022 and come in at 350,000 for 2023. That's way above expectations, and that looks to be factoring into the housing market via both direct demand to some extent and through rental markets where we're seeing very tight rental markets and rising rents. The second factor that stands out is a surge in construction costs. So newly built dwellings are seeing price gains of about 18% over the last year, and that's shifted the balance between new and established dwellings. The third factor is very thin on-market supply. Sales have dropped significantly over the last year, but new listings have fallen by even more, and that looks to be seeing some compression in sales to listings ratios, and that's telling you that you've got quite a tight market for those that are out there buying. There still look to be significant headwinds though. The gains that we've seen in some markets are very lopsided. Sydney in particular is being driven by the top end of the market. More generally, prices look to be about flat to stable. And we still have significant headwinds obviously with interest rates still rising through February and March, and we think there'll be another rate hike in May. And the economy more generally moving through the associated interest rate shock that's driving a slowdown in activity. That's still to play out over the course of this year. But what we're seeing around consumer expectations suggests to us that there's stabilisation in prices is pretty well established. Consumer house price expectations have moved from negative to about neutral, or actually quite positive, slightly positive. That tells us that to see renewed price declines come through at this stage would require quite a substantial shock. We know also that consumers by and large are bracing for further rate hikes, so it would take more than just a May rate hike from the RBA to see a restart in price declines. So to us this is showing genuine signs of a stabilisation that will sustain, and while we don't expect the conditions are there for a continued gains in prices this year, we think we'll be about flat for prices nationally over the course of 2023. 2024 is when we will see a more sustained rise emerge. The key here is around the RBA. We think the inflation threat will have diminished sufficiently to allow the RBA to ease rates significantly over the course of 2024, and that'll give this recovery more traction, and we'll start to see a more sustained rise in prices. We think prices will rise about 5% in 2024. That's an upgrade on a 2% rise previously. So just to recap, the market's showing clear signs of stabilisation. We think prices will hold about flat from here in 2023 with a sustained gain coming in 2024. The risks are still there around inflation and interest rates, but it looks like it would take a large shock to see renewed price declines come through the market from here.